Can you tell us more about yourself, please?
I grew up in Southern California. I went to UC Irvine, studied economics, and then I went into energy. Worked in green energy for like 10, 15 years. And then eventually I went to the Haas and energy was pretty slow. So I I pivoted completely to start a crypto hedge fund. And that worked out really well. We ended up being like the number one in that world for a year, which was really, really cool. It was me and a couple buddies. And then from there, I wanted to get more involved and kind of have more impact again. So a couple years ago, my professor of entrepreneurship called me up. I was an investor in his first fund and on the limited partner advisory committee. And then me and him are now co-GP on fund two. So yeah, I'm really excited about that. I love giving back. I love mentoring, and I love trying to make the world a better place.
Thank you for sharing that. So, one of my questions is a notably high share of your portfolio is led by women founders, and you give back to the Berkeley community. So, what experiences or people shape those values for you?
So a big part for me growing up was my mom in the household was kind of the person, well, she definitely was the person who made more money. She rose the ranks in her career. She went from being a secretary with no college degree to by the end of her career being an executive with an MBA. And so I got to see that happen in my family and in my household. I was born in the 80s and then grew up in the 90s. And so there was still a male, I guess it still might be a little male dominated world, but to see that my mom was able to do that and to see the struggles that she went through with her coworkers, it really, when I saw anyone be like, oh, well, males do this or males should do that, I was like, no, that's not true. And I actually have a mom that showed me that exactly. And so I feel like I didn't have some of the more inherent biases in me that others had. And so I try to just look at everything as meritocratically as possible, as opposed to gender or sex or race or whatever it is. And so with female founders, I'm also into math, but like the female founders have an outsized chance of success. And I think some of the limitations of it are because they don't have the access or people don't treat them with as much respect at times. And so I think it's actually just mathematically, it's a better bet to make. And then if you remove your biases, you're just looking at who you think is going to be better. And so I end up gravitating a lot more towards, I guess, towards, I don't know if it's giving them more respect or giving them equal or whatever it is, but seeing that they have significant potential. And so like I'm usually good friends or friends-ish with the founders that we're investing in. And I really appreciate that they give us that opportunity.
Wonderful, thank you. So, what made you build your deal flow around the UC ecosystem with UC Berkeley at the center of it?
So our founder is Kurt Beyer. He's a 15-year professor of entrepreneurship at Haas, and he's a really, really cool guy. His wife is also a coach. So she coaches at Enneagram. She does executive coaching. And leaving the business school, I actually wanted to go into coaching. And so I had lunch with her. I still remember I was kind of cracking up. I was in class one day and he was talking about the Enneagram and his wife, and I wanted to go in coaching. I knew all about the Enneagram. And so I asked him in the middle of class if I could have his wife's phone number, like kind of as a joke. He just gave it to me right there. And then at the end of class, I went up to him. I was like, "Hey, is it okay if I actually reach out to her and have lunch with her and like chat?" And he's like, "Oh, for sure, man." So he's just a very giving, kind individual. And then he actually has a scholarship that he sponsors for Annapolis, where he sends one of the top grads to Cambridge every year on a full scholarship. That's all provided by him, all out of his own pocket. And so with this fund, he said he wants to give 50% of it back to the university to promote entrepreneurship. So it's very value aligned for me in what we're doing. And then Kurt's a big proponent on staff. We have, I think, over 50% female employees working with us, and we invest in female founders. I think Fund One, we were at 35% of our companies had female founders. Fund Two, we're over 50% right now. And so we're really trying to do good in the world. And I don't think we have as many biases, hopefully.
Well, thank you. I appreciate that. So I want to switch gears here and talk about your decision-making process and timeline. How do you evaluate founders? Who do you know who to pick and all that?
So we really, there's a couple of rules that we go by, but really it's that like we'd want to quote grab a beer with them, and that we feel like they're really value aligned. We have a no punk rule. I'd say we sometimes call it just something else, but just people that we really want to work with and people that are value aligned. We're not impact mandated as a fund, but we're pretty impact driven. So 2/3 of our investments have something that makes the world cleaner, greener, or nicer. And so we love to find founders that are aligned with that. And then given that one of our mandates is we invest in founders that come out of the UC system. So one of the founders or really early hire had to come out of the UCs. Usually we have pretty good connections and we can kind of like triangulate whether or not these are really good people, how much expertise they have, how they work on teams. And so we get to find out a lot about them. And then we meet with them personally. And then something I try to do is take like, if we can, 6 to 9 months to get to know the founders before investing with them. You get to have coffee with them, you get to go to lunch with them, you get to see them in various settings. And so you're not just like swooned by 1 or 2 meetings, you're actually seeing who the person is, and then they're seeing who you are, and you can both make an agreement on whether or not it's a good investment.
That's amazing. I'm going to give you a follow-up question. I know that you mentioned the 6 to 9 months. I went to an event, I used to working maybe a year ago, and there's this gentleman who said that your fundraising action plan, your FRAP should be for founders, should be 2 to 4 weeks. You should just close in those 2 to 4 weeks. Do you think that's old wisdom at this point? And is that really true of the reality of where we're living today?
I think there's a lot of different ways of doing things. I don't know if there's like a single right way of doing anything, right? Even if your funding window is closing in that time, you can build a relationship before then. So a lot of times it's with founders. One of the questions we always ask, when is your next raise? What are you trying to time for that? And if they're raising in March, okay, I'm going to stay in touch with them and then I'll have my timeline built out. If we have a like really rushed entry, usually that is a little scary and we tend to go away from that, but we can still get to know them a little bit or try to expedite that, like have a couple meetings with them real quickly or have 3 meetings. And then we can go and we can quickly kind of check in with our network. I'm not a big fan of like a pushy sales cycle, so I don't generally appreciate that, but I know that strategy works really well too. So I'm not going to like shun that strategy. And then it's just how you come off. Like we're building long-term relationships. We're going to be partners with these founders for 3 to 10 years. So if you're rushing into a long-term relationship, not the smartest thing.
Yeah, I appreciate that. And one of the advice that people give to founders is create FOMO. So from the investor perspective, what turns you off about that, or what makes it right for a founder to do that?
I think FOMO is a very powerful tool. If you look at like human history and human trends, like, okay, so if you just go to trading, one of the best trading strategies ever is just follow momentum. When it goes below a certain trending line, that's the momentum downwards. When it pops up on like a weekly or monthly chart, that's when you reinvest and then you ride it for several years and then you exit. It's very simple, it's very easy, and it follows psychological rules of humans. So just like FOMO for fundraising works, it's the same thing. You really want to build that momentum. I forget his name, but there's like the 5 rules, which is like reciprocity, other people coming into it. But if you look at those 5 rules, they're very human psychologically based. And so building FOMO and pushing that it's really wise. And then there's just ways of doing that are like more shady than others, or shady versus not shady. Like, hey, I have these investors, I have 10 people on the line, I think they're going to give me this much money. That's one. Or, hey, I have 10 investors that are locked in. I got 5 million allocated. I'm ready to go. Do you want to get in for our last 100K? That might be a lie. And so that founder, I'm not going to trust as much. Whereas his first thing is like, oh, he's got people on the line. The second one will definitely get me more like tuned in because I'm a human, I'm a mammal, I have these responses, but it's not as truthful. And then if you find the truth out later, then you feel burnt and then they've hurt your trust. And so I always want to build a relationship that continues to compound the trust.
That makes sense. So what do founders misunderstand about how VCs make investment decisions?
These are generalizations, of course. I think one of the big things is that for me, it's that like, oh, you don't want to invest in me because I'm not like a rocket ship or I'm not some like AI thing or whatever. And then it's really every time I make an investment, I'm not saying fully, I believe in you. I am saying that, but I'm saying I believe in you and I'm willing to put my investors' money up for this thing. This is a risk and this is a fiduciary duty I have to this thing. And so I see this more in like clean or green tech or like more mission driven things. They're like, oh, you're just a greedy VC. And they're like, no, I'm not a greedy VC. I have a job. My investors paid me with this money and this is my job that I have to do. So I'm doing my job. If my job is to target a company that has rapid acceleration, that's because I'm a venture capitalist investor and that's what I'm targeting. That's the deal I made with my investors. And some people are like, they just don't look at that the right way. And that's where I try to explain that I think there's different capital allocations. So you can go to foundations, you can go to private investors, PE, you go to a lot of other places. So is what you're building aligned with venture returns, which need that hockey stick, or is what you're building just aligned with something else? And there might be a better capital pool to go to. And so I don't know if all founders get that.
Got it. Now that makes sense. Doing one's homework is important. So what makes a founder particularly effective at working with investors on a board in your experience?
I think for all these, it's just empathy and it's understanding the angle that the VC is coming from. So going to school and like mentoring a lot of students, they all just want to tell you how amazing the thing they built is and how they built it. That's great. And that is very important. We need to know that. But we need to know as investors who have our investors' money that we have to put up for this, whether or not it has a right growth rate, where you're going to fundraise again, what your runway is going to be at that next place. And so it's really mapping out those financials 12, 24, maybe even 36 months in advance with the milestones that you need to get to that next fundraise. Because we're saying, I'm going to give you this money now, and you're going to go try to do X, and I'm going to try to help you with that. And then in a year or in 18 months, you're going to raise again, and you're going to have this much runway, and that's going to give you more negotiating power. It's going to give you less stress. It's going to help us all achieve our goals. And so really aligning on what that financial path is something that we see is not as well thought out in the early stages of a company. And then like just huge caveat, you don't know all this stuff either. Like you're a pre-seed company, you haven't gone to market, you don't know what your scalability is. And so that's where taking smaller checks at first and then scaling up over time is kind of how that is done. So you can prove that track record and prove that growth. And then really speak the VC's language of here's how we're targeting getting those returns for you and getting our next funding round and being a stable growth company.
So thank you for that. Speaking of that, getting smaller checks first, what's the difference between having the right amount of small checks versus having a crowded cap table for you?
I wish I had a great answer.
It has evolved in the past few years, actually. And where's it going?
Yeah, I think different people see it differently. For us and most of our founders, the recommendation is like, if you have money and you have a decent and you're monitoring your own equity, like you don't want to sell out your own equity because then you lose your own motivation. And then if you have to do a down round or a flat round later, it's really going to cause a lot of problems. So I don't think having too crowded of a cap table is that bad, but just really watch it. So like, I guess one example, we had a startup, we invested pre-seed, we're the first check-in for this one. That's very rare for us, but we did that. They took, I think 3 or 4 angel checks there. And then they raised at about 3.5 million. They're looking at their next raise at maybe a 15 million post money. So right now we're just like, what's the strategy for angels? We're recommending taking in angel checks at 8 to 10 million, but maybe making it like a 25K minimum so that you don't get 50 new checks, you get like 4 or 5, and then your cap table's not too crowded. And then talking to other VCs, generally that feels fine. I think more of the institutional ones will be like, oh, that seems like too crowded of a cap table. So it could be a problem, but I don't see that as a major issue. I see taking like dozens of checks as an issue.
Got it. That makes sense. And on that note, how often do you lead around?
So we don't lead rounds. We only follow. We're like sub $25 million fund. That said, we have bridged a few rounds, and then this pre-seed, we were the only institutional check in there, but it was a safe. So it's not technically leading, but we'd be willing to do that a few times. But those are like smaller numbers.
Awesome. What kinds of support from a VC should founders be looking for, which are generally valuable after the investment?
Feel like that's all case by case basis. We look at the founders because we invest on the founder basis mostly, and then product slightly second. We look for what gaps the founder has and then how coachable the founder is with those gaps and how open and willing. If they're not at all coachable or willing, then they're going to run into problems down the road and we don't invest in them. Not that they have to take what we say. That's not at all what I'm saying. I'm saying if they don't listen to anything, like big difference, right? And so if the founder has a lot of gaps or has a few gaps and they identify that, then can we fill that gap, or do I know people who can fill that gap? That's really important. If the founder, it's like second time founder, we have one second time founder. She's a total machine. And I don't think I can provide any help to her other than writing a check to her. And then I just get out of her way. And that's fantastic. Other founders are first time founders. There's a lot of foibles that you can run into. So I talk to them more frequently. We're friends and we can check in. So it's like, we had this cap table discussion 2 days ago. How can I introduce her to scientists that can help her review some of her studies? Or can I introduce her to factories that are going to produce her goods in the future? And so I'll use all my connections to try to get those things for her. But the other founder, I'm just getting out of the way.
I love that. You touched upon something that's interesting to me is founder coachability. So tell me something like when is it what is the right blend of that? When should founders push back? Not just, I'm not talking about you, but push back to VCs, and when should they incorporate the advice? Like, is there a certain do's and don'ts around that you might give some advice to some of our first time founders?
I took this course a while ago called New Ventures West, and it had these levels of development of people. And one of them was like a baseline, like immediate needs, like you're just getting your needs met. And then the other was basically the end goal was like busy. You're just busy, you're doing stuff. And so most people are busy. And there was a third one that was called conversation. And conversation meant we can have a two-way conversation about anything. And I'm going to put out my opinion, you're going to put out your opinion, and we don't hold back. We don't say anything rudely, but we don't hold back. I think every founder VC conversation should be at this level where you say, hey, I think you should do X, or one of the thoughts is X. And then they say, here's what I think on X, or I haven't thought about X. Let's talk about it. And then you can just have a very open conversation. If like I'm coaching a founder and I've done this thing 20 times, and I'm like, look, this is kind of just how this thing's done. Like 20 times it's worked out every time like this, then usually that's a more clear conversation. But if like, hey, here's a strategic decision we think, let's weigh the pros and cons, and then let's put it out on the table. And then at the end of the day, founder, that's your decision. We're not going to make that for you. We're going to nudge you. And if you decide not to do it, that's okay. We had a conversation about it. So I really think founders should stand up for themselves and their own opinions, and then lean into more of what they don't know or haven't done before. I think that's just how I try to operate personally.
I love that. And speaking on that, something that's been top of mind to me lately is founder burnout. Like going on meditation retreats, going on camping retreats. Like, how often should founders take a time out the weekend and just get out of Dodge and go somewhere
I think
to recharge, not just to.
I mean, that's very like personal, difficult question. I think as often as is required, for sure. We all get to like a certain level of burnout at times where our brain starts wiring itself differently, and too much cortisol in our body, whatever it is, like you're just not operating the way you should be operating. You got to go take a break. If that break is an hour, or if that break is a day or a weekend, do what you need to do. A lot of the founders they're just so driven that they're already kind of wired tight. And so it's really hard to know that. I think as a VC, I mean, as a human, you can kind of tell that in people, and the more close your relationship is with them. I was joking around on a text with the founder last night, and I thought the comment I said was like extremely sarcastic. She's going to some pitch competitions. This last one, she had like 7 people trying to teach her how to pitch, and she's already won pitch competition, so she doesn't need to get taught how to pitch. And she was just like kind of complaining to me about it. And then so she moved on to the next round of this pitch competition, and I was like, oh, hey, like, do you want me to go find some pitch coaches for you? And then I even put like too soon in parentheses. And then she was like, no, what are you talking about? Blah, blah, blah. And I was like, oh, that was totally sarcastic. And she was like, oh, sorry, I'm burnt out right now. Like, my bad. I actually get the joke. So we had that level of communication where we could joke around about it or recover from a bad joke per se. It's just having that conversation and being able to check in with each other, and then like apologizing quickly if it feels like it's an all overstep.
Yeah, I love that. Thank you for that. I have a few more, and I think we have a little bit of time here. When you meet a promising founder, what signals make you want to keep the conversation going? I know we already kind of touched upon this, but if you can expand on that, please.
I really like people who are very mission driven, the whole product founder fit thing. And so if they really want to get a cause done or accomplished or achieved, and you can see that, and then you can also see the coupling of deep expertise and knowledge in their space. And then you can also see that they've been like diligent over the course of their life. So they have a kind of history of it. If you have like those 3 things, I'm super interested to talk with you more. And I think most of those people are ridiculously curious, which is just like maybe one of my favorite traits in people. And so that kind of balance really leads itself to future conversations. And then I find that curious people generally are more cooperative, and you can have more like back and forth conversations with them. And so that's also just a style of person we want to work with more. Extremely diligent, extremely curious. I think you can almost get anything done with those 2.
I like it. So what's keeping you curious these days?
My thing is building out the AI infrastructure for the VC fund that I operate. I mapped out all the roles of the fund, like on an org chart and everything. And we've built almost all those roles into it. So I have like all these, I have 5 Telegram agents that I can go talk to for sourcing or for IR or for this or that. And whatever, if anyone's into vibe coding, there's like an Obsidian or a Hermes thing that basically learns everything that's happening. So it reads all my emails. It learns every week. We go over new lessons every week with it. And so my goal is almost to replace myself with this system. And that's been fascinating. And it allows me to connect more with people. It allows me to spend more time with the founders, allows me to go to more events at school. And so really just AI enablement for greater human connection and for deeper kind of diligence and review all at the same time. And then if we really do it right, we get to invest more money from the fund as well, because we spend less money on other work that we would typically need to spend more money on. So I've been super curious for that. I learned how to vibe code like 4.5 months ago, and now I built an entire system and it's fantastic. So it's just kind of what you can do with that curiosity. And then the next part is just figuring out where to go on campus to talk to more people, or what events to go do that you can really have meaningful conversations with founders.
Awesome. I love that. So looking back at your portfolio, what's one trait that your best performing founders shared at the earliest stage?
Maybe hunger in a weird way. Like it aligns with curiosity a lot, but what we've seen, so a trend we see at school is there's these different competitions that you go in to pitch your startup and build it, and you're building it obviously behind the scenes. If a student goes through like all those competitions, if they find out about them on their own, if they're going to the networking events, they're really just hungry to make it happen. And to build these companies in a VC world that needs to have this kind of hockey stick performance, you kind of have to like live and die by your company. And like, it's the thing you're always doing. Part of what I hope to do with my job is to coach founders out of being founders after their company is successful or not, and help them kind of land back in the real world, because the requirements of being a founder are pretty draining. I've been there. I know what that's like. You kind of lose yourself. And so I want to find founders that are really hungry and really diligent and really driven for the cause, because they're going to have to put up with a lot of stuff to really make it happen over a multi-year period. And then I want them to also hopefully be able to land on the backside of that and return to having a very normal, very full life, and kind of maybe get a little thing off their shoulder that was bugging them.
No, I love that. How has your view of a strong startup changed over the past 5 years? And also just going forward, it seems like there are fewer IPOs as well. So how are you adjusting for that?
So when we invest in a startup, what we look at is the possibility of a short, like a 2 to 5 year, 2 to 4 year exit, a medium, like a 3 to 5 or 6 year exit, and a longer term, 6+ years. And then we look at who could be the purchases or the exit for that. So there's a lot of things around it, but like ever since Sarbanes-Oxley, more money has been pushed into private capital and out of the stock market, so less IPOs are happening. But you still get a lot of purchases. So like a biotech company, we look at what pharma would buy it. For other startups, we have another startup like, would Bayer buy this, or would Novonesis buy this, or something like that in the science. So you always want to have your exit partially planned, or at least theoretically planned. We have run into a couple startups where they were like, oh, hey, I think after we raise this round, we never have to raise money again. And unfortunately for them and us, that means maybe we shouldn't invest in you, because we have no way of getting our investors' money back. So like as a job, I have to know when I can possibly get that back. And if I can't get it back, then I can't invest, because then I'm just kind of giving away their money. So always having that kind of exit planned, and then look at where that might happen. Because since there is more private capital, you're getting more buyouts that are happening in that private market.
Definitely. And what separates companies that become category leaders from companies that remain promising but never break through?
So we do a fair amount of like deep tech. And I think in deep tech, it's really like, do you really have a technical advantage? And can that technical advantage translate to a cost competitive product? And if you have that, then you can be a market winner over time. It's a lot of very hard work. It's not like a formula for success, like prescriptively, but that is the formula that you want to follow. If you're another company, I think it's really aligning with your mission and like staying focused on that. I think what I see with some startup founders is, okay, what I really like to see is there's this pain point. My thing solves this pain point, and this is my sole objective, and I drive everything towards it. That's so clear. It's so linear. Everyone can get behind it. I see other founders, And generally they're like a little more salesy. They're like, oh, there's this thing, but we could do this and we could do this and we could do, and it's like, you're just going to lose focus. You got to sprint really fast in this game. And unless you're deep tech and you have this really clear technical advantage, you're not going to be able to win the market. You're just going to be the fastest sprinter. And I don't personally like to invest in the fastest sprinter because there's a whole world out there that I don't know. But if I can see the tech is better, or you're really driven for a cause and it's a not busy market, then I know you have a much stronger chance of making it, because you'll be the industry leader or one of two industry leaders in that market. And that really allows for a breakout.
I love that. Thank you. I had somebody half my age ask me, what do you want to do when you grow up, Neeraj? And so I'm going to pass the baton on to you. What do you want to do when you grow up?
I really like this. I love finding out new things. I'm super curious. I love working with founders. I think my life's mission is to help other people achieve their goals, so long as their goal is aligned with something positive in the world. Like, I really spent a lot of personal, spiritual time, like, finding that. And so I really want to do this. And then in the back of my mind, maybe like 10 years from now, I try to be like a stand-up comedian and able to tell a lot of stories and just share some laughs with people. So something that's positive.
I love that. I love it. Awesome. Well, thank you so much. Do we have any questions from the audience? Chanuan, maybe you might help guide me on this?
Sure. So, yeah, we have one question here. While I'm not raising my first round yet, if how much effort should I spend on building and maintain relationships with investors?
I would say do some light, like, browsing if the people in your space, or if you have a couple contacts that can introduce you to some VCs or angel investors, depending on where you're at. It's never too early to build those relationships. But what we really like to see in the really early founders is, hey, I have this plan and this mission, and I'm checking in with you today. And then I check in with you again in a month or 2 months from now. And here's how I've evolved that, Brian. I've talked to 20 new customers. I've signed up 2 new contracts. I've built this new website, like, whatever those things are, seeing that traction over time and that growth over time. And the follow-up to say, I was going to do X, I did X, and here's what I'm doing again. And then you can show me again, you're going to do that. Yeah, one of my favorite phrases, acronyms, is DWYSYWD, which is like, I'll type it in because it's a mirror. It like folds on itself, but just do what you said you would do. What you said you would do. Yeah. And so, like, if we talk to founders a lot and they do that, then that's a really good signal that we can build a long relationship. And then the really nice part about it is I love the conversation. Hey, I think I might raise money in the future, but I just wanted to start talking to you now. It's like everything goes down. It's like a first date that has no worries or no concerns, and like the air is just easier. And so you're like, oh, cool, I'm just here to help. And here to help conversation is much better than, do I want to give you money or not conversation, which is a little more antagonistic.
I think that's something a lot of our founder always struggles. They have sometimes like VC angels want to give them a check, but they don't want to be the lead. And then they try to chase the lead, and along the time they can't find a lead. So how to solve that problem?
I don't know if there's like a clear solution, and the later your round goes, you need just richer leads, so that the pool of possible leads decreases. For what I try to do to help those founders is, so we have some really, I think it's really impressive review material, the companies that we're looking at. We do a pretty thorough review. We like have a list of advisors that we can introduce them to, and we try to do that. So I try to build momentum with the founders. And so, like, we know a couple leads that are looking at so we just put a safe in this one company. I really like them, love the founder. She's amazing. And so I've now talked to the other VC that might be a lead several times. I've sent them emails. I've sent them all of our diligence. And then I can go try to find other advisors in the space that can go talk to them and kind of like backdoor conversation, so that your people who are willing to write a check for you are also going to bat to you with that lead. I think this does a couple things. One, it gives the lead a little more confidence. Two, it shows the lead that that company has someone that's willing to fight for them as well and do some kind of interesting creative things, which they know is going to play out in other ways as well for that company. And then other than that, just ask all your investors and friends, like, hey, who could lead in this round? And can you make those warm introductions? But yeah, it's hard. It's especially hard right now. I mean, it's hard for funds to fundraise. It's hard for companies to fundraise. We have 4 startups so our Fund 1 has 28 portfolio companies. We have 4 startups that are raising. All of them are running out of cash, even though they've hit all their milestones and look very good on paper. And one of them just got a major term sheet, like tens of millions of dollars. but it's not a great term sheet, but it's what they're getting and it's what they're going to take. And that's just the environment that we're in.
One question is, from what I'm hearing from the friends and the top tier asset management firm, the current market looks remarkably similar to the dot-com crash. They emphasize it's critical to rush fundraising now because by later this year or next year, it may be too late. What's your take on these? I'm asking because I'm the co-founder at a fintech startup and we're currently prepared to start raising from VCs.
Okay. So yeah, whenever there's a market crash, everyone runs the door and there's not enough room at the door to get out. So everything gets crushed in price and then no one can get any money. Like generally that does happen. There's always money though out there to be given out. And like we have our capital calls. So like we're going to be getting a certain amount of money every year for the next 5 years. Granted, people could fail their capital calls, pretty uncommon. But if you're performing very well, and you're meeting all your metrics and you're at a reasonable price point, I think you can find the money. If you are worried though, so like one thing we tell all of our startups is you should have at least 12 months of runway beyond your next planned raise. So if you're raising in 12 months, you should have 24 months of runway minimum, maybe 36 or maybe 30. And that will give you plenty of breathing room. So if the market crashes, bear markets, if you look at it, they're like maybe 4 to 6 months long. So if there shouldn't be a liquidity gap for more than like 6 to 12 months. So if you have that built-in runway and you can trim things later, then you've built in your safety net so you can avoid this problem in the future. And like number 2 or 3 problem for startups is running out of money. So just plan that all in advance as much as you can so that you don't have to rush bringing in too much capital right now and you can kind of breathe a little easier. Like we really want to help our startup founders have less stress. And so having a little more capital for that additional runway does that.
Great, thank you. Another question is, can you elaborate what you mentioned earlier on about storytelling for early stage startup versus metrics for later stage? So for early stage startups, are there metrics that should still be focused on to support the story?
Yeah. So for angel check or pre-seed, maybe that's all in the same bucket, and seed, you're still generally at a story stage. Hey, there's this technology, or hey, there's this mission I'm on, and here's these things I've sold it to people in my community, or I built a sample of this deep tech thing, or I built a sample app, whatever it is. You're really selling the story that this is a pain point in the world. I am the solution to that pain point, and I think there's a market for that to happen. And here's how I plan to get there generally. And that's just all story or predominantly story. What we really like to see is you've talked to customers, you have a history there, you've done a lot of work. If I talk to other professors at school, they're like, oh, I can really count on Joanne to do all this stuff. She always shows up early. She always has all the homework done. She's always ahead of this curve, whatever. So then we can see like these data points very early on in the storytelling that show that you're really mission driven and mission oriented and you're taking the steps. And then as it moves to like seed or series A, it's have you signed on the customers? What's your pipeline? What's your conversion ratio for your pipeline? What's your recurring revenue? Or if you're in biotech, like how are you looking on the studies that you're doing, like in vivo or pig studies or whatever? Like what results are you getting? And can we get any preliminary data on those results? Because that'll give us the opportunity to say, hey, yeah, we're willing to put a check in, or once we see X, we can put a check in. And it's just like some kind of transition over time. And then if you're like with the prior question, as you get to market downturns, every investor gets more conservative. And so it's less about story and it's more about metrics and have you done it before? And so first time founders are going to have a harder time in those down markets. Everyone's going to have a harder time. They're going to have a particularly harder time. And then metrics become more and more important. As you get into money's free flowing, then it's a lot easier. Stories go a longer way. And then you get those people who are like, yeah, I'm raising $100 million fund, like company. I'm taking $10 million in my pre-seed round. Like that's total BS. I don't care who you are. Like I'm never investing in that, but that's where the money's just like flowing out the door, and a good story and some name recognition gets you a lot.
Okay, thank you for the answer. Okay, that kind of also the next question kind of follow up with these. So there's so many founders are building public, share their journeys on social medias. How useful is that for investors?
It's like if you're going to a late stage investor, I don't think it matters. Again, you're like in more metrics. If you're just building momentum or trying to find that connection, I think it matters a lot. Like just very anecdotally on my own end, like I've had investors who come in and are like, hey, I'm investing in you because I generally like you, but I also like love Cal and I love that you donate to Cal. And so me sharing posts about how we donate to Cal or going to school and mentoring and doing stuff like that, it really resonates with them emotionally. And so they want to invest, which is cool because that's why I'm doing it too. Whereas other investors, they'll be like, are you wasting your time on social media? Are you just storytelling and not building? What are you doing? And so it's like they can see it a bunch of different ways. And that's where I like to find alignment with them. Like, you got to tell some of your story. You got to get out there. That's your job. I'm investing in you and I'm investing in your idea. But so there's like, I don't know, I'll say it's called the circuit. If people are going on the circuit, like if all I'm doing is going on podcasts and talking about how cool CalFund is, I'm not actually doing my job. I'm just talking about CalFund. That's not actually my job. It's like an addendum to it or a barnacle on it. So if a founder feels like they're doing the circuit and they're just doing the circuit, then no, I don't want to invest in you because you're just telling a story. You're not building a business. So there's that like balance you have to try to find with, are they telling a story to build their business and to help it? Or are they just telling a story? Because we've made the mistake and invested in a founder who just told a story. Really, really, really good storyteller. Turns out she practiced all the time on it, but that one didn't work out well because she just wanted to tell a story and the business line.
Next one, when you look at back your best founders, what early behavior did you consider green flags?
Diligence, follow-up, curiosity, willingness to adjust, like be slightly flexible, not totally flexible, obviously, that they're doing. And then, yeah, like I hesitate on urgency or responsiveness. Like some founders I'll text and they'll text me back in like 30 seconds. I'm like, what are they doing? Like, were they
Oh.
the phone in their hand? Okay, cool. Like I'll do the same sometimes. But like when you text them, they will get back to you in like 24 hours, maybe 48 or very quickly. And then if you're going back and forth on something, it's just bing, 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 and that's good. But yeah, I think it's reasonability, drive, motivation, passion. So I did a lot of personal spiritual development. I went to Bali for like a month. I just did yoga and meditation and all kinds of deep personal dive. And so I really look at the character of people and I really read a bunch of like micro expressions and I look for cognitive dissonance in characters. And so if you look at all that stuff, you can tell if people are being authentic with you or if they're not. And I can't invest in people that aren't authentic, because if you're not authentic with yourself, then you're lying to yourself, and then you're inevitably going to lie to me at some point in time or your other investors. So I really try to look at that from a character and alignment perspective.
That's a good point. Okay, one question is about solopreneurship, because there's a lot of solopreneurship. How you look at that? Do you invest in a company like that?
Yeah, we do. I definitely see it as like I don't know, like a yellow flag. There's a lot of trouble that you're going to run into in a startup, and having just someone to like emotionally help you along that ride, that's a founder that's with you, I think is really, really helpful. I think some solo founders can totally rock it and have a great time. I also get worried that solo founders need to make their own decisions. They need to be in control. And that's like a little bit, it touches on the coachability spectrum of like, are they actually coachable and will they listen? And if something major comes up that they're just on the wrong side of the boat, will they come over to the other side? And so there's like slight warning signs that no, they may not. Now, is that a deal breaker? No, but again, if you build a relationship with the founder, I think you can get a little more insight into whether you're comfortable with them as a solo founder.
So question is, if there's a founder has more VC chasing he or she, and how the founder can evaluate who will be the best fit for them?
I mean, it's going to be cheesy, but like follow your heart on it. Like really, who are you going to want to work with? You're going to work with these people for years. They're going to offer you similar term sheets. If there's like deep networks across them, like is one network going to be better than the other? Are the networks almost fully overlapping? Like are the VC networks like this or are they like this? Like how overlapping are those networks going to be? And so not just follow your heart, but like if you're going to get similar support from the different groups, then who do you really want to work with and who do you value align with? Because that's going to make you sleep better at night in the future. And those are the people that are going to come to bat for you, whether you perform well or not. When things get rough, are they going to push you to the side because they have too many other companies, they don't really care and you become a burden? Or are they going to dig in with you and sit there and try to solve a problem late at night?
There's some questions follow up with what you mentioned about 5 million revenue. How much do you weigh in? And how founders build the finance function? And what's the first thing you see break?
Oh, wow. That is a complicated question. So I think at 5 million revenue, you should definitely be having a CFO. Like you get a lot of fractional CFOs today. I think that's a great way to go. You probably don't need a full-time CFO for that work. You just need to make sure all your books are good. I think so. I look at a lot of like stylistic differences between the founders. There's very like salesy founders. Salesy founders always want to build the next revenue channel, do the next thing, grow this. For those founders, it's like sit on your hands, don't do the thing you want to do, pick one, not five. And so you really have to like, I don't know, a bad analogy, but like they're like children. You're like, no, just try to focus here. And you just try to like bring them back to focusing. And then there's the like the opposite end of the spectrum, which is like, we have this money, but like, I'm really unsure about this. Like, I think the safe route is to do X. And so those founders, you have to nudge to do more, or like, okay, you found product market fit. Now you got to scale that sales team super rapidly. And that's not aligned with that person's style. And so you have to nudge them there. And so like, it's not like the company does one or the other wrong. It's that the founder's style leads to the company operating in a certain way. And sometimes they have to stretch out of their style a little bit.
Yeah, that's a good point. We see a lot of, especially for female founder, they get money and they host the money and they don't want to hire, especially salesperson, if they find the tech background. And it's always very hard to push them. Even the investor always ask me, like, why she's not hiring? I was like, I don't know.
Yeah. Yeah. I mean, and it goes both ways, right? Like I have one friend who like hired a salesperson before they had product market fit. And then I went back and I was like, what were you doing, dude? And he was like, well, I thought we were right there. I was like, you thought you were right there versus you were right there. Like there's a huge difference between that. And it's the overconfidence of the salesman type CEO versus maybe, I don't know, lack of confidence or conservative style of the non-sales CEOs.
That's a good point. Well, we are on time and I really appreciate.
Bryce, thank you so much. I know you're very busy, and thank you for taking the time to come out and just talking to us.
Yeah. Thanks so much for having me. Really.
Thank
Awesome.
you. Thank you.